right now, you might not be able to unmute your mics until after that. I'll allow you guys after that to do it. So what I'm gonna do real quick is give you guys a quick run through, because we do got some new people on Financial Alchemy Pro. So I'm gonna spend about 5 minutes or so going over the website real quick as far as how they can navigate a lot faster. So real quick, let's start with this. So each tab at the top up here, this is how it's gonna look when you log into your back office. Most of you already know this. If you look at the top, you got the FA Beginners Training, FA Advanced Training, FA Professional Training. Each one has 6 different modules besides it, or 5 different modules besides the Beginners Training. Once you finish the Beginners Training, at the bottom of this page here, it's going to say Student Lounge. Okay, you can click on the Student Study Lounge as well. But the main important part here is the FA Secret Vote. So again, it's at the top search bar up here. If you click on Secret Vote, it's going to take you to another aspect of the website. Now with this Secret Vote, what you can do here is you can watch the live news. Yes, this is 24/7 live news. So you'll be able to watch the live news here. So all the world news, anything that comes out that's relevant to economics, currency in general, you'll be able to log into your back office and watch that news here. At the top as well, you got a few more tabs. One of them is Basics of Currency. Pull up a page that's going to look like this. This also has the live news, so you can kind of multitask. Now, this here is just a lecture going over just the basic currency movement, a good introduction as far as like the broker accumulations zones and live trading sessions. So you'll see a lot of different things within that one video there. The third tab here is NFP Secrets. So again, it's going to go over some of those NFP secrets. You also have upgrades down here. And we got Currency with Mr. Dio and Currency with Mr. Jason. So on certain days, these 2 instructors that get on, they'll let you know when they'll be. And the only thing you have to do is click on that tab, and basically their webinar is streamed from the back office back here. You just type in whatever the nickname you want it to be, and it'll show you them going live on their own webinar there. Currency with Mr. Jason works the same way. Then the FA Lounge. So where the FA Lounge is for, this is where you can mark up your charts. While you're marking up your charts, you can watch the live news as well. The guy has the integrated trading view on here. It has the different currencies and different price levels of the currencies. So if you scroll down here, you'll see the integrated trading view pop up. Then you can mark up your charts back here as well. You can post your setups down here. So you'll be able to add the setup, obviously post a picture in there. Then we'll be able to see those setups as well. And the most important tab is the FA Live Webinars. Now, sometimes we will stream through FA Live Webinars tab, so it might not be a Zoom link that goes out. But also what's going to be in this FA Live Webinars tab is the replay. So tonight's replay, you'll be able to watch it down here. On this FA Live Webinars tab, you have the Forex correlation, so you see exactly what currencies correlate with the other ones as they do change. You have the different sessions as well, so you know what session you're currently in. Right now, we're in an overlap session between Tokyo and Sydney. Shows you exactly how many hours are left on each one of those sessions as well. Down below, you have basically the economic events. So you can also use this for your economic data sheets as well. And the replays, the only thing you're going to do is just type in whatever nickname you want to put there, and you'll be able to watch the previous live replay here. So this is from last week. So those of you who are new, you can watch the last week's live replay within this area as well. So that's what I wanted to do, is just give you guys a real quick run through on how to actually use this. Another thing is, if you log into your back office and let's say that this screen pops up where it says hello, whatever your name is, If you want to get back to your actual training, you're going to click on areas. Okay, then you're going to click where it has like a little door symbol with an arrow. Click on go to area, and it's going to take you to where you left off at. So wherever you left off on your training, you'll be able to access it and see it right back there as well. So that's how you kind of navigate Financial Alchemy Pro, the website. Right below every module, you have the different tickers of each individual currency. It's kind of giving you different ratings on strong buys, sells, and things like that. Always do your own analysis, of course. Okay, you got the live tickers at the top here as well. Now, let's just say you wanted to go directly to one of those charts outside of the website. Only thing you got to do is click on it, and it's going to take you directly to that specific chart that you were wanting to look at as well. So I did want to go over that real quick because, like I said, we got some new people, and I want them to know exactly how to navigate Financial Alchemy Pro. So tonight, let's go ahead and start with our psychology, which is what we're actually going to talk about for tonight, and next week we'll go into the data sheets once again. Another tool that you guys will be able to use after you watch your Financial Alchemy Pro DVD and you go over Financial Alchemy Pro, before you kind of get into the platform, we got a 3-video series on YouTube, which I'll post in the group as well. That's going to go over some stuff that you guys kind of need to know in the beginning, because we post things in the group such as data sheets and so on and so forth. So we want you to be able to really know how to read those data sheets, how to create them, and understand them to the best of your ability. So let's start here with our framework. So we're going to begin with the psychology aspect. What I'm going to do is kind of break down a lot of information for you real quick. So let's kind of begin here. So Currency Guy's reflexivity framework. As you guys may know, reflexivity is a concept that was created by George Soros, the only person to make over $1 billion in one day trading Forex. So the main root variables for this overall thesis are the X and Y axis. Now, I know we go over this a lot, but I want you guys to, know this like the back of your hand, know why the markets move the way they move. So as I said before, the first two main variables are considered the X and the Y axis. This is how charts were kind of established. This is why you have those quadrant-based charts with those different, different price levels, time, and things like that. So the X variable is considered the unknown, and the Y variable is considered the known. Now, we deal with two phenomenons as traders. The first phenomenon that everyone works in the moment they enter a trade is called the human phenomenon. The HP is to react to what you see in the markets. Now, the easiest way to remember this is just think about it in the sense of you are driving, down the street and a traffic light turns yellow. You begin to slow down, which is a basic reaction to what you see. Okay, you know to slow down because you were taught the rules. So these are the rules behind Forex trading and we're going to go through now. Yellow means slow down, red means stop, and green means go. So the human phenomenon is you reacting to the color of that traffic light. So just to put it in layman's terms, you react to the direction of the market that you see. If the market was clearly going up, you would want to react basically by buying. If you see the reversal kind of occurring, you're going to react basically by selling. Okay, so that traffic light and you driving has the same concept, and it's all considered a human phenomenon. Now, remember, the X variable is an unknown. Okay, so the human phenomenon is considered unknown. Now, the natural phenomenon is when the direction becomes obvious to you in the markets. So let's pretend that this is the markets now. All right. So the natural phenomenon, as I said before, is when the direction becomes obvious. So let's say the same traffic light is now red. Okay. Everyone knows what you do. You make a complete stop. So at this point, you've made a complete stop because it's obvious that the traffic flow has stopped completely. Okay. Because if you don't stop, obviously you're going to get into an accident. Okay. So these are the two basic rules behind this overall market direction. So looking at this, let's say this is the markets, we can clearly see that the market is in an uptrend going up. Now you see the pullback. Okay. that's not the overall direction. That's exactly what it's called, a pullback. The overall direction would be bullish or the market moving up. All right, so these are the two phenomenons that you work in as you trade. Now, to make it make a little bit more sense to you, the currency market's movement is based off of fluctuation of price. Okay, that fluctuation of the price is based off the expectations of other traders. The direction that the traders see the market's currently going in is what they expect to continue to happen. Not realizing that the markets are self-fulfilling, okay, and that there's no equilibrium. When the markets, just because the markets go up and down, okay, that's exactly what's going on. There's no actual buyers and sellers of anything. The reason why there's no buyers and sellers, actual buyers and sellers, is because there's no perfect competition. Okay, there's no 50-50 area within the markets without you going through the process. So this is why you guys learn the 6-step order of operation. The first step that we have to do is we have to create that equilibrium. Okay, so how we create the equilibrium, let's pretend this is the market moving up and down like that. Step one is to create a trap. Once I create that trap, now I'm able to use my Fibonacci retracement and find that 38.2 zone. The 38.2 zone is acting as your equilibrium. This is where you have the 50-50 odds at your best chances of buying or selling. Now, there's rules behind that. And as most of you may know, 3 consecutive candlesticks above, the direction is bullish. 3 consecutive candlesticks below, the direction is bearish. In this case, the best odds would be the next time the market touches this 38.2 at this level would be to buy. Okay, so step one we did was we created the trap. Step two, we created the trigger. Well, really, step two was create the trap. Step three would be the trigger, because the overall step one would be check the bias. So that bias is allowing us to know if the dollar is stronger or weaker than the opposite pair. So I'm going to read this statement one more time, and we're going to relate it to what I just said here. So the currency market's movement is based off of fluctuation of price. That fluctuation of price is based off of the expectations of other traders. The direction the traders see the market currently going in is what they expect to continue to happen, not realizing that the markets are self-fulfilling and that there is no equilibrium within the markets because there is no perfect competition, because there's no actual buyers and sellers. The words buy and sell in the currency markets mean up and down, which therefore show us direction and not supply and demand. Since everyone's expectations are different, price fluctuates, which is the reason why the markets look like that. Because if price didn't fluctuate, we can have one straight line that went up, and that same straight line can come straight back down. So what supply and demand are, this is the buyers and sellers within economics. Okay, as a buyer and a seller, as a buyer or a seller, a buyer is only going to buy what they want, need, or have to. So therefore, it creates perfect competition between the buyer and the seller. So within the currency markets, that's not the case. Okay, we don't have that luxury. Let's say they don't buy what they want, need, or have to. You buy what you see within the currency markets. So currency's movement is based off of price, time, and events. So instead of us having 2 variables, we have 3: price, time, events. So therefore, we have to keep track of all 3 of these different variables to understand where the markets are going overall. So the first thing that we're going to talk about again is this human phenomenon, and we're going to create subcategories. So price is considered a human phenomenon because it's unknown. And the natural phenomenon, time will be considered a natural phenomenon because it's unknown. Now I'm going to go into detail on what exactly that means. So time is the most important thing in the currency markets. The reason being it's a known dominant variable. The main reason time is more important than price is because time enables price to continue in its natural direction. Okay, time is also the main factor in micro and macroeconomics. Economics lead price, which in theory, if it was not the case, price can continue in an irreversible direction. So that would be that straight line theory that we talked about. Price will move in an irreversible direction because as a trader, your bias would never really change without an element causing or allowing you to react, aka those pullbacks and retracements. So again, show you this 2 examples. So this is what we wish could happen, and this is what actually happens. So let's read the statement one more time. Time is the most important thing in the currency markets. Reason being is the known dominant variable. The main reason time is more important than price is because time enables price to continue in its natural direction. Time also is the main factor in micro and macroeconomic events. We know the time those events come out. We know the days that they come out, and we also know the results. Economics lead price, which in theory, if it was not the case, price can continue in its irreversible direction. The reason being, there has to be an element causing or allowing you to react. So these pullbacks and retracements are the elements that's causing you as a trader to react to the markets and its overall trends. So if we didn't have these pullbacks, there would be no reason for us to think that the market was going to go down. The market continue to go up and continue to go down basically forever. We wouldn't be able to judge price. So time allows us to do that because time allows micro and macroeconomic events to actually take place. So let's talk about those micro and macroeconomic events. Events is a natural phenomenon. The reason why events are a natural phenomenon is because it's the obvious, it's the known variable. Micro and macroeconomic events are all known variables that give us either a positive or negative result. That equals the variable difference will show us either individual currency strength or weakness. Okay, so those events, we're able to create probability based off of how many events were positive and how many events were negative. And that's going to show us the actual currency strength or weakness, aka that's how we create our data sheets. Now, time, on the other hand, that's also obvious or known because we were able to ask these 2 questions. Did price change since the last events were released? Yes or no? When is the next event? We can just go look at the global economic calendar and we're able to see that. So these are known variables that can be answered. Now, price, on the other hand, is a human phenomenon, okay, which is a reaction. It's an unknown. Now, this would be it. This would be the question here. This would be the answer, I should say. This is how movement is measured. So the only reason that we have those candlesticks in the charts is this is how we measure movement based off of the probabilities of positive and negative event results. This considered an unknown variable because there's no way to test the accuracy of price at a specific point in time. So price, time, and events are all equal to currency pair direction. Price, time, and events are they all three have to be equal. They all three work together. So these 3 variables work together to establish a true trend. Now, the human phenomenon or price, candlesticks show us where price is and where prices went. So we can measure and trap current price in a range. That's step 2 of our order of operation because it showed us where price was and where price is. So when we do our support and resistance or our high and low, we're able to trap the market within a range. Okay, so now we can measure the trap in this current range and we're able to see things such as accumulation of orders, but one thing that we can't see is the volume. All right, so volume is an important aspect of trading, in which we'll get to, but we cannot see the floating price because of a decentralized market. There's no primary exchange that all transactions run through. So we know that there's $5.3 trillion being traded every day, but we don't know how much is being traded at any particular point of time. There's no way to actually know the exact number for the simple fact that it's a decentralized market, which means that the volume differs from broker to broker because all the transactions aren't running through one primary exchange. So why would volume be so important? The reason why volume is so important, it shows the quantity of currency. It's the simple fact of following the money. If I had, let's say, $500 million being bought and on Euro USD and only $200 million being sold on Euro USD, the odds of the Euro USD going up is far more likely than it going down, because I have more money being traded and being bought rather than being sold. So volume for Forex cannot be officially quantified because there's too many brokers, both regulated and unregulated brokers. So all cash flow cannot be accounted for. We know that the daily cash flow of currency is $5.3 trillion a day. The open position ratio shows us a percentage of how many buyers and sellers we currently have at a specific point of time for any broker. So we're able to calculate the floating price using candlestick volume and order sizes. So this is the volume calculation, in which we're going to start to talk about for the next 2 weeks or so, showing you guys the importance of volume. So the volume calculation works this way. One standard lot is equal to 100,000 units of currency. So one standard lot is a 1.00. Okay, so basically you're trading 100,000 units of currency. One standard lot is equal to one open position. Okay, one standard lot is equal to 10 volume points for every one standard lot. So this is the volume realization. So 1K volume is what you want to be looking for. 1K volume was sustainable to create a true trend. 1K volume is equal to 10,000 orders. 1K volume is equal to 10 million units of currency. Okay. When you see 1K volume on your charts, that's equal to 10 million units of currency being bought or sold at that particular point in time. 1K volume is equal to 1% open position ratio. 10,000 orders move the market 1 pip. Okay, so that's the volume realization, in which we're going to speak a lot about. But what I want to wrap this up with is I want to wrap it up with what you're going through as a trader, what we call as the cycles. Okay, so very first and foremost, let's go over these 3 basic things. So the human phenomenon happens to all traders the moment that you execute a trade. It's the reaction. The natural phenomenon is when the market goes in your direction or against you. So no matter if you are right or wrong, it's going to be obvious. The moment you realize you're in profit or not in profit, you're going to begin to emotionally react by either exiting or remaining in a trade. So the HP x NP is equal to emotional reaction. So the emotional reaction is this. This happens when you're in a trade and you can either be in profit or not. Your brain automatically begin to emotionally react by asking yourself this question: should I exit or remain? Once you make that choice, you now have an expectation for the markets to move in your direction. Now that becomes self-fulfilling. Now, controlling your emotional reaction is a little bit harder. You have to first recognize that you're having an emotional reaction. Then you must use the human phenomenon to create a new bias. Okay, so what the human phenomenon is to basically react to what you see. This will allow the trader to observe the patterns and react and repeat this linear loop between cause and effect. So this is what you're going through, and every trader goes through. The first step is the human phenomenon. You reacted to what you see. The next step is the natural direction. The market does what it wants, basically does that pullback before it continues in its natural direction. The third one is the natural phenomenon. Now it's going to be obvious if you were right or wrong, because you're either going to be in profit or not in profit. The moment that you realize you're in your profit or not in profit, you're going to emotionally react by telling yourself, should I exit or remain? If you don't go through the process again, you're going to create an expectation for the markets now. Now you're going to look at the markets in the sense of self-fulfilling. Now you're going to think now you're going to say, you're going to relate everything to why you're right or why you're wrong, rather than you going through the cycle again. Go and redo your setup. Get all your confirmations over again. Reconfirm what it is that you were looking at. And that's what we'll kind of be going over for the next 2 weeks, is these traders loop and how to kind of step out of that aspect of trading and to go into a more professional stance. So the trader's loop is the psychological cycle that you'll go through as a trader from the moment we enter a trade to the moment we emotionally react. That's develop that expectation all over again. So the trick here is to align yourself with the current market cycles. So again, tonight, it was all about psychology, and I want you guys to really get a good understanding of it. This Zoom might X out on me at any second. I just know how they do it, but I'm gonna try to open up the floor real quick for questions. And as I said, we're going to start speaking about a lot more reflexivity in today's society. So we're going to talk about a lot of things that President Trump is doing with these trade wars and how we can kind of capitalize off of it. Another thing to remember is we got Brexit, October 31st, 2019. That's going to be a big deal for the euro and the GBP pairs. So we always want to keep a close eye on that. I'm gonna unmute real quick. You guys, you can unmute yourself now if you got any questions about anything that we kind of talked about.
Hey, hello?
Yep, I hear you, Reggie.
Yeah, when you was talking about the 10,000, the volume.
Yeah.
I was give me just a clear understanding, and I'm just trying to get a clear understanding.
So solid. So basically the way it works is, let's say that you had entered the market with one standard lot. Okay. So this is basically 100. You're trading 100 units of current, 100,000 units of currency. Now, the most important part about volume is it's showing us the quantity of currency that's being traded at any one particular time. Now, the reason why you need to know volume, because it allows you to able to follow the money a lot easier rather than just looking at the direction of what those candlesticks are saying. So if I'm looking at, hang on. If I'm looking at the charts and I look at my volume graphs, which I'll show you real quick up on the charts. So I'm gonna pull up a chart real quick just to give you a clear idea of how the volume looks. But if I'm looking at the charts and I see that, let's say we have 10,000 units of currency being traded. So what that means is 10,000 orders, okay? All right, so 10,000 10,000 orders equal to 1K volume. All right, that's equal to 10 million units of currency. All right, so this is telling me out of the 5.3 trillion units of currency that's being traded a day, 10 million units of it is being bought or being sold at that particular point in time. So it's going to help you follow the money a lot easier. So let me show you it on the charts as well, how the volume is going to look on your charts. So let me switch screens. Let's go over to the vote real quick. FA Lounge. All right, so on your charts, you're going to have, you want to put this on your charts. It might not be there right away, but I'm going to show you how to add it real quick. All right, so if I go over here to, it's on here, perfect. So you see these little bars down here?
Oh yeah, okay, yeah.
Okay, so let me go over to the side chart here. Hang on one second. You know what, I'm gonna go directly to Trading View. I'm gonna go directly to Trading View and show you. All right, so it's gonna give us basically red. It's gonna either be red or blue, and basically red is obviously indicating bearish, and blue is gonna be indicating bullish. But it's gonna be in thousands. And this is how we're able to know how much currency is being bought or sold, and kind of which one is winning at the time. Is there more buyers? Is there more sellers? So I'm gonna give you a quick visual here so you can see it. Okay, so you got the little volume here, and if you want to click on data window, so you see right here where it says volume. Now, right now it's at 890. So when this gets to 1K volume, that's telling us that there's 10 million units of currency being sold. Yep, being sold at that one particular time. So if I hover over another candlestick, like here, there was 12K volume. So that was 120 million units of currency being sold at that one particular time. Okay, and then even bought. So if I hover over the green one here, there was 110 million units of currency being bought at that one particular time. So what it does is it helps us follow the money a lot easier. So 1K, yep. So that's the easiest way for you to kind of confirm your direction as well. After you do your setups and everything like that, this is going to show you the reversal before your setup does. The volume is going to shift. You'll have less volume or more volume going the opposite way, and you'll be able to kind of follow the money a lot easier.
Okay.
All right. So I'm gonna just explain. I'm gonna say it one more time though, as far as like the what each one means real quick. So one standard lot, 100,000 units of currency, one open position. It also equals to 10 volume points. So for every one standard lot, there was 10 volume points added. Okay, so volume realization is here. 1K volume is sustainable for a true trend. So this allows the trend to continue in this direction. 1K volume is equal to 10,000 orders. So once that gets to 1K, we know that 10,000 orders has been placed. 1K volume is equal to 10 million units of currency. 1K volume is 1% open position ratio, and 10,000 orders move the market at least 1 pip. So if we seen that we had 12,000 12K volume, then we got at least enough for a 12 pip move. Does that make sense?
I understand. I got you now.
Okay. Solid. All right, so that's what we're going to be talking about for at least the next 2 weeks or so now. Like I said, once this gets to 1K, we at least got enough for a 1 pip move. Like here, once this was at 11K, we had enough for 11 pip move. So every 10,000 orders move the market 1 pip.
1 pip.
Okay.
All right. So yeah, that's a good question though. That's a good question.
Thank you, man. Appreciate it.
Oh yeah, no doubt. All right, anybody else? Jared, Matt, Jay. Well, Jay, I know you straight, G.
Man,
I don't know where. Oh, what you say, G?
I'm looking at this consolidation. My chart look just like yours. I'm so upset.
Oh yeah, slow motion, man. You know how it is.
Hey, Jesse, how you doing?
I'm good.
Welcome back.
Mm-hmm.
How you doing, Jason?
Hey, Robert, quick question for you, man.
Oh, yo, I hear you, Matt.
Hey, quick question. What's your opinion on the fact that the yen has been driven down to almost record low level right now, and it's hovering around like 7. That's almost like a record low level it's been. And how do you think that's correlating to gold taking off right now in the market? Jason and I were talking about this earlier than last week, so I just want to get your opinion on it.
I mean, honestly, I'm just going to continue to watch the dollar. Because as you know, if the dollar goes up, then gold gonna go down. So it's like really, I'm just keeping a close eye on the dollar. I don't really pay attention to the correlation between gold and UJ, just because it constantly changes. It's like, and it's hard to kind of gauge all the time. So I just pay attention to that dollar. And on a side note, I haven't even traded gold in a long time. But yeah, so I would just say really pay attention to the dollar and how the economic events come out for the week to basically make the best decision on that.
Appreciate it.
Yep.
And man, it did say, like, I checked some news, like the 30-year yield, whatever, is down. It said its lowest point for the U.S. dollar ever.
Oh yeah.
Straight currency manipulation going on right now, man.
Yeah. So they looking for another recession. So I don't know if it'll hit. Like they hovering around like that Fed cut. But if it's another one, when that Fed cut comes, there's gonna be a lot going on.
Yeah. And like one thing me and Debo been noticing for the past like 2 weeks, just watching this dollar, is that really is like is just being stimulated. Like if you watch like literally by like 12 o'clock tonight, this dollar might jump down, 10 points. And then like for Euro USD specifically last week, didn't do nothing. It moves up 50 pips, back down 50 pips. It literally has been in the same area for the past 2 weeks now. So it's like, really it's choppy. It's this dollar that's choppy. Last time I checked the dollar, I believe it was 97 something. Here, let me go and check real quick. So that way I'm not guessing. Let me go running my data sheet. Can't even see my data sheet. Where is it? Oh.
It is. Let me see.
Yeah, but last time, I got it.
47.46. Yeah, I got mine on.
Yeah, it's so I checked it the 7th, so about 5 days ago. The lowest it was at 97.37, 97.68. But look where we started at the beginning of the month. We started at the 98s, you know. So really the dollar is depreciating, but it's like every time it jumps those, you know, even little ticks, it just causing so much, you know, chaos even to gold, you know, and gold is like gold really it respects the dollar in the sense that if it gets weak, it's gonna go up. If it gets strong, it's gonna go down to that point. But it just even then it's like it's hard to gauge it because there wasn't even any economic events that was major around, like I said, 11 and 12 o'clock at night. Nothing was coming out, but the dollar just was jumping, you know, just kept jumping back and forth, back and forth. And, you know, like I said, I've been tracking it and just kind of seeing a difference in it overall, you know, so even now at where we are compared to 5 days ago, it's gained strength, you know, so you kind of got to gauge this and make sure that, especially you, Matt, when you trade and gold, at least keep a close eye on the variable difference between where the dollar started off at and kind of gauge between where we are, you know, currently. So I would just keep a close eye on it.
Gotcha. Will do, man. Appreciate the advice, man.
Yeah, no doubt, no doubt. All right, let's see. All right, I got like 50